All right, we see people starting to join, and as the first few people are filtering in, I don't know why Zoom never lets everyone in at once. It's just like one by one. Um, just want to make sure everyone can see the slide, can hear me, see me, can see Paul. Raise your hand if you can. Thank you, John.
Thanks, John.
Um, all right, perfect. So we're right at the top of the hour here, and Paul has a lot of content to get through. Um, so I think we will just get started promptly here. As you might guess, by the fact that I'm here and Brian is not, that's because Brian is traveling and on the in-person speaking circuit. Once again, this is kind of the last go before everyone buckles down for busy season in the holidays. So this is sort of the last travel season for him. So he asked me to do the usual introduction. If you've seen any of our webinars before that we host every month, you'll know that typically we do an introduction of kind of who Charitable Solutions is and the services we provide, and to the extent that we can, kind of how that relates to the topic of today's webinar, which Paul Casperson is going to take us through. As far as housekeeping items go, we typically do not make the slides available. However, what we will do is after this webinar, probably next week, we will send out a recording with the best of either Tuesday's session or today's session. We'll also send out combined Q&As in a Word doc with all the questions and answers from Tuesday and today. And then in this case in particular, Paul has a great paper that he just published that is on this subject, and we'll send that along as well. So slides won't be distributed, but there'll be a bunch of other content. And if you do want to watch the presentation again, that is completely available, completely free. So we'll get all that out probably next week. And with that said, what does Charitable Solutions do? I'm just going to go through a few of our services here. At a high level, planned giving, risk management, and like it says there, that's our mission, making charitable gifts happen that otherwise wouldn't. That is kind of how all of these things tie in, is uh, risk mitigation and facilitating more complex gifts. So starting in the top right, moving in a generally counterclockwise direction, Emergency Assistance Fund Administration, actually how I got my start working with Brian and the Charitable Solutions team. Has grown a ton over the last decade and has been doing a lot of work lately for hurricane relief in the Gulf Coast and Western North Carolina. So that's been very busy lately and has seen a lot of growth. Professional Advisor CE, webinars like this on a monthly basis, but also in-person talks and other virtual presentations when we're asked to speak, which Paul does a lot of. Brian does a ton, of course. John Severson, who's watching today, and Russ Willis, who probably is as well. I do some of that myself. So a lot of our team members are doing professional CE and speeches, especially at conferences, of which there are a lot this month. Charitable appraisals, a fast-growing service arm for us. Our slogan there is, if you can give it to charity, we can appraise it. I think we were stumped with a quarter horse, but just about any other asset that can be donated, we can appraise. That includes things like business interests, real estate, artwork, collectibles, cryptocurrency. I've done quite a number of those myself. So that's something where typically we're not involved in the actual donation at all. And in most cases, we usually cannot legally be involved in the donation, but we can do the appraisal work if there's another charity that's managing the actual gift process. Charitable gift annuity risk management, again, tying into the sort of risk assessment, risk mitigation. A lot of gift annuity pool audits and gift annuity reinsurance are kind of the focus there. The National Gift Annuity Foundation, the largest independent gift annuity pool in the country, one of the largest gift annuity pools, period, in the country at this point, with I think over 1,000 contracts at this point. So quite a large pool in all 50 states, I should stress. We were in 49 for quite a while and then finally decided just to bite the bullet and get that registration in Hawaii. Anyone who knows gift annuities knows the challenging states and probably would have guessed Hawaii was the last one. And then finally, and certainly tying into Paul's topic today, non-cash asset risk management. We do this kind of in two main ways. One is with consulting with charities where they're looking for assistance with evaluation of proposed non-cash gifts, onboarding of non-cash gifts, sale of those assets, sometimes even just high-level gift acceptance policies and developing those. So we'll do consulting with other charities and then also working directly on those gifts, often into our donor-advised fund, Decami Foundation, but also, and this is where it ties into today's webinar, sometimes utilizing a tool like a Charitable Remainder Trust, where that trust is being funded with a non-cash asset, most often real estate in my experience, but not necessarily real estate. So that's kind of a high level of who we are, what we do. With that in mind, I'll go quickly to Decami's activity. Now, this is last year. This is 2023 activity. As is literally underlined there, 100% of these gifts were declined by the referring charity. So when we talk about making gifts happen that otherwise wouldn't, this is that in action. 161 donations that otherwise would not have happened at 1.1 billion in total value. One thing I will highlight here, several of these were funding charitable remainder trusts and charitable gift annuities, exactly on the charitable remainder trust side, what Paul's going to talk about in just a minute. So we saw some of that activity last year in 2023. We were seeing it in prior years as well, and we've seen even more this year in 2024. Paul and I were just talking about one such case right before we started the webinar. So a lot more activity for charitable remainder trusts in 2024, and that's kind of in keeping with what we've seen directly in terms of overall non-cash activity. It's been a very, very busy year. And I expect it will exceed the 2023 activity. And our partners that we've spoken with anecdotally have by and large kind of confirmed that and said they're seeing the same thing. So really busy year. We're into the final stretch here with less than 70 days left in the year. And that kind of takes us to Paul's presentation, because it's all about how to get these charitable remainder trusts closed out before year end. So with that said, Paul, looking forward to learning a whole bunch here.
Okay, thank you, Ryan. Can you hear me okay?
Yeah, you're coming through fine. Yeah.
Okay, great. Good morning, everyone. Normally I say good afternoon at this time, but good morning from Anaheim, California. I'm at a conference out here and heading then to the NCGP conference next week. So for those of you who are going to be there, I hope to get an opportunity to see you in person. For our time today, we're going to talk about closing CRTs in the final quarter of the year. Now, what you're going to find is that what we're really going to be talking about is universal to any time throughout the year. But the point of kind of this year-end urgency in our title is that often this is the quarter, usually November, October, this is the time where the CRT opportunities, there's a risk of losing those opportunities because you run out of time before the end of the calendar year to make them happen. This also happens to be probably the most activity throughout the year in terms of financial transactions, and the work that Ryan does, particularly in M&A. A lot of activity happening in those final couple of months. So there is something to this idea of being prepared for that final quarter. But what we'll be talking about is generally universal. We did a webinar in September of 22 on CRTs. It was a primer. that covered pretty much every aspect of CRTs. So if you're still new to CRTs, I would encourage you to go back and listen to that webinar. We're going to go through a primer real quick. Part of that primer also is, though, how to introduce the CRT concept to donors. And I thought of some axioms that you really need to kind of remember as you're working through a CRT process with a donor or a client. Then we'll cover some case studies of completed CRTs closed in 24. Honestly, one of them was a 23 gift, but uh, I kind of had to stop myself. I have, I think, 5 different examples of case studies. I really wanted, then I remembered all these other ones that I wanted to share as well. I just shared 5 that I think are kind of practical case studies, that things that you might see out there in your communication with donors. Um, Parts of the process of setting up CRTs, and obviously part of that is the drafting of the CRTs. So we'll talk a little bit about that, and then we'll end with talking about our 3 service models at the Decami Foundation, where we can serve as a trustee for charitable remainder trusts. So with that, let's start with a brief primer. Now, CRATs, charitable remainder annuity trusts, the use cases for CRATs are continuing to dwindle over the course of my career. In the late 90s, early 2000s, I saw a lot of CRATs, but we're starting to see that be replaced either with the fact that maybe a CRUT makes more sense because it's funded with non-cash asset. And we'll talk about that here shortly, that you really have to use a CRUT when you're funding a CRT with a non-cash asset. The other maybe reason why we're seeing CRATs dwindle is that more people are preferring the simplicity of a charitable gift annuity, and they go that route. Another reason might be that when the 720 rate was so low, before 2022, that the 75/20 rate was so low that a lot of folks who were interested in setting up CRATs, they wouldn't even pass the 10% remainder requirement for a charitable remainder trust. So if you're new to CRTs, one of the most important rules when you're considering who your income beneficiaries are and the term, whether it's going to be a term of years charitable remainder trust or whether it's going to be for the life of the income beneficiaries, is will ultimately, when you put all that together, does the trust pass the 10% requirement that actuarially 10% of the remainder go to charity when you set up that trust? So those are the reasons why I think you don't see CRATs as much. So let's pivot to talk about CRUTs then, because that's where the majority of our activities are going to be. If you're familiar with CRUTs, you know that the payments are variable based on December 31 every year of the trust term. When you have that value, then that value will set the payments for the following year. CRUTs happen to be the most versatile of the two, and are going to be the choice that you would use for funding a charitable remainder trust with any asset other than cash or publicly traded securities. Now, prior to 1997, funding a charitable remainder trust with illiquid assets, you had basically one option, and that was to set up a net income charitable remainder unit trust. And it would remain a net income charitable remainder unit trust throughout the entire term of the trust. There are still trusts out there that are simply net income charitable remainder trusts. Somewhere around 1997 or 98, there was further legislation around charitable remainder trusts, because what was happening was, if you set up a net income CRUT in the 80s, even the early 90s, the net income was pretty generous. You were getting a pretty significant amount of income. But as interest rates continued to go lower through the 90s, and definitely in the 2000s, there was this need for something more with charitable remainder trusts. So there was further legislation that created something called a flip charitable remainder trust. I think everybody on the call has probably heard what a flip charitable remainder trust is. Some of you may have been part of establishing those. So let's walk through very briefly how this tool works. So let's say that you've got a donor who has just reached out to you about making a gift of vacant land in your community. It's a very nice piece of property, and it's October now. So your donor just got the appraisal back, and it's appraised at $1 million, right on the nose for easy math for us. So the donor is able to take a charitable income tax deduction this year based on the actuarial present value of the remainder interest. If you subscribe to PG Calc or Crescendo, you should be able to get that number pretty easy, but you can't really give them an accurate number, of course, until you have that appraised value. And then once you have that, you can plug those numbers in using the 75/20 rate, and your donor will get the charitable income tax deduction in the year that he makes the transfer to the trust. So now we're in October of 2024. If we were fortunate enough as trustee to be able to sell that real estate before December 31st of 2024, then we could flip and we could convert to a standard charitable remainder unit trust for our donor. But let's say, unfortunately, we're not able to, this is vacant land. It's not exactly as liquid as maybe a single family property. So we're just not able to get it sold before the end of the year. So now we're going to have to wait until January 1 of 26 to flip, to convert to a standard charitable remainder unit trust. Now, until that time, your donor is entitled to net income. Well, while the trust owns the vacant land, there's clearly no income. So if you did have real estate that was producing rental income, that's great. We'll talk a little bit more about that in a slide or two. But in our case, we don't. But after the land is sold, let's say that we sell it in June of 2025, and it's invested in a portfolio of stocks and bonds. The dividends and interest income from those investments are net income. So that would be able to be paid to your income beneficiary, to your donor, until we reach January 1 of 2026. And then we flip, as you can see, down to number 4. We can then convert finally to a charitable remainder trust rate that is required by law as a minimum of 5% to be paid out to your income beneficiary. In this case, let's just say for the rest of his life, and then the remainder to your organization. So in a nutshell, at a high level, that's how a flip charitable remainder unit trust works. Now, let's jump into real estate, because as Ryan mentioned earlier, the majority of our complex CRTs are funded with real property. And so one of the first questions that you have to really have answered by the donor is, do they want to structure this as a flip net income, which is what I prefer, or do they want to set it up as a flip net income with makeup charitable remainder trust? And you might say, well, what's the difference? The difference can be significant. When it's a flip net income, the donor is just entitled to the net income during the pre-flip period. And if there's no income, then the donor doesn't receive any. But because we set up the CRT to pay 5% in the previous example, and it may take a couple years, maybe it takes 3 years before the trust flips. If you set it up as net income with makeup, then you have to pay out the 5%, or up to whatever difference is between what was paid up to the 5% in those previous years. And that can be a pretty significant tax hit for your income beneficiary, and maybe they don't want that. And 2, it takes a pretty big chunk out of the corpus of your trust right out of the gate. So you just have to talk to your donor. What is their goal ultimately? Hopefully in most cases, a net income CRUT. What type of real estate is it? You know, is there an operating business involved? So let's talk about an oversimplified example of what is an operating business as it pertains to real estate. Let's say that you've got a donor who owns farmland, and they're the landowner, they're not the farmer. And they donate farmland to a flip charitable remainder unit trust, and there's a tenant farmer on the property paying cash rent. Rent is not unrelated business income tax, nor is dividends or anything like that. So in that case, you're fine, but let's just change the topic or change the scenario just subtly. And your donor is 50-50 in an arrangement with the tenant farmer, that you say, I pay for half of the expenses, the inputs to grow the crop. I pay for 50% of everything, and I get 50% of the net income. Um, and the tenant farmer, you do the work, I sit back, I get to sit back because I'm the landowner, and that's how the arrangement works. That's an operating business. And the income generated from that operating business is going to be unrelated business income tax. If you've been around the game for a while, you'll know that before 2008 or somewhere in that time frame, a dime of unrelated business income tax could disqualify the charitable remainder trust. So naturally, accountants, attorneys, and others were very concerned with even just a little hint of unrelated business income tax. Well, since then, the UBIT will not disqualify a trust, but the income itself is taxed at 100%. So it's not much of an improvement, but nonetheless, it wouldn't disqualify the trust. But it's something that you do want to watch out for, because it's not beneficial to have that. And there's a lot of charities that it's a little kind of a gray area on some of their activities, whether it should be UBIT or not. Like my example always is, and I really don't know the answer to this, but a hospital that has a gift shop in it. Is that gift shop technically tied to the mission of the hospital? You could make a good argument that it is. But if the hospital got into the pizza delivery business, the IRS may come in and say, "Hey, uh, we don't like this. You're going to pay income tax, and if you do too much of this, we're going to take away your 501(c)(3) status." So, in a nutshell, that's how UBIT works. And so, a charitable remainder trust has no mission. So, no matter what the business income is, it's always going to be taxed as UBIT. So, just one of the important aspects, if you're funding a CRT with any type of asset that could be an operating business, a limited partnership, sometimes real estate, like in my example. So just keep an eye out for that. Are there potential environmental hazards on the property? I'll tell you a quick story about how a CRT can be a great solution for a donor that's trying to make an outright gift of real estate, and the phase one comes back a little dirty. In my time at the University of Florida, we had one of our top donors giving us a bunch of different real estate gifts. And one of them was an old like mechanic shop, or might have even been like a Jiffy Lube type of place. And it had some serious environmental issues in the phase one. Well, our legal counsel said, well, we just got to go to phase two. And if you understand anything about the due diligence of environmental around real estate, you'll know that there's a significant issue with phase two. I'm not saying that you should never go to phase two, but two things there. One is that the cost is significant. So you're going to spend literally thousands of dollars only to find out, well, what if there are, serious issues? Well, the gift isn't moving forward, and now you're just out $10,000 or $15,000. So really, what good is that? The other is that depending on state law and the EPA federal laws, the engineer may be legally required to disclose to governing agencies their report on phase two. And so you could basically, kind of ruin the future of that real estate for your donor. So my proposal was, we can't go in the title chain. Let's let our donor be the trustee of a charitable remainder trust. We'll kind of help him get this thing set up. He will donate the real estate to a charitable remainder trust. He's a very wealthy individual. He does not need the income from the CRT, so he could just, within a year or so, he could terminate the CRT early, and then, it basically making an outright gift. So it was a way for our charity to keep out of the title chain. Another good use case of CRTs. If there's debt on the property, debt again is going to trigger unrelated business income tax. It's also going to trigger a gain to your donor attributable to their basis. If the debt to equity ratio, I've heard Ryan and Brian talk about this, if it's under 30%, maybe it's still worth pursuing. But if you've got investments that have more than that, and it's not just it's not just generally real estate. It could be a limited partnership that owns real estate that could be a very valuable investment. But if the underlying partnership has debt, you're going to have these issues related to UBIT and tax issues for the donor. Who owns the property? And that might be a good segue to talk about closely held business assets. So a charitable remainder trust cannot be a shareholder of a sub S corporation. It would lose its S election. So often with real estate, it can actually real estate can be owned by a sub S as well. But now, kind of pivoting to just operating businesses, the C corporation donations generally can work out very well. Ryan Raffin, who's here with me today, has seen a significant number of donations over his career. He's one of the best in the country in walking donors and charities through these types of complex assets on the closely held business side. But the most important thing to keep in mind is that a sub S cannot be a CRT cannot be a shareholder of sub S. But I will give you in one of my case studies an example of a workaround that. Appraisals, obviously, if you are donating any asset other than cash or publicly traded securities, and the gift is over and the deduction is over $5,000, $10,000 for closely held business, then the taxpayer needs to get a qualified appraisal. That's true outside of charitable remainder trusts. In this month's issue of Trust and Estates, which is the entire issue is dedicated to charitable planning, as Ryan mentioned, I was published in there this month, and you can have access to that paper if you'd like. But there was an article from Jonathan Tidd about some random issues with charitable planning. And one of the things that he pointed out is that the regs in 2019 really changed some of the rules around the requirements for qualified appraisals. Now, generally, our back office is extremely familiar with these rules that most appraisers and most advisors across the country aren't even aware of the types of statements that the appraiser has to make inside the appraisal. Everything completed on the 8283. That's I think one of the greatest value adds that our organization brings is working with the donor and their advisors to make sure these documents are airtight. Well, anyway, in Jonathan's article, he mentions that one of the regs that is in how it's interpreted is that the new rules provide that if a partial interest, such as a remainder interest in a CRT, is given to charity, the partial interest, not the asset itself, is used to fund the CRT. And in Jonathan's example, he was talking about publicly traded stocks. And so that's that's something that most individuals are kind of shocked when they hear this. And remember that the regs are the IRS's interpretation of the Internal Revenue Code. So it's really going to be up to the tax court if you ever had a donor that was challenged that did not have an appraisal for a CRT that was funded simply with publicly traded stocks. But this is definitely something that has gotten my attention, and it's something that I'm going to look a little further into. I think the majority of folks are going to continue to take the average of the high and the low stock, and because that's just the way it is, for outright gifts of publicly traded stocks. But Jonathan, who's one of the great plan giving attorneys in the country, one of the greats ever, when he says something like this, you definitely need to take notice. Gifts of art or collectibles. I won't say a lot about this. The majority of my experience with tangible property funded in CRTs has to do with agricultural assets. And my friend and colleague on the call, John Severson, has done a number of these as well. But that's really where I have had experience with CRTs funded with thousands of bushels of corn and soybeans. It worked out great for a retiring farmer in his last year. And we worked with a different farmer. This was in my days at Iowa State University, a different farmer who donated all of their depreciated farm equipment when they retired, right before they sold that equipment on auction. Um, Significant value in those assets. But generally speaking, what are the rules around funding CRTs with tangible property? The general rules is that when you fund the CRT, it's going to be your deduction is going to be the lesser of the cost basis or fair market value. Why is that? Well, with any asset that's a tangible property like a collection, the only way that you can deduct the full fair market value is if the organization has a related use for it. Like an Andy Warhol. I'm donating an Andy Warhol to the Met. They have a related use for it. I deduct the full fair market value. A CRT, no matter what, does not have a related use for tangible property. So it's always going to be the lesser of the basis or fair market value. And then furthermore, that deduction can't be used until the actual asset is sold. So the benefits there aren't as good from a deduction standpoint as, say, donating stock or real estate, because you are getting to deduct the full fair market value. But we know that currently the capital gains rate for selling these types of assets are higher than any other type of asset, 28%. You throw on the 3% Affordable Care Act and then your state capital gains tax, and you could pay a significant amount of tax just to sell an art collection or something like that. So a CRT is still a good use case in the right circumstances for that. Okay, so let's move on and talk about how to introduce the CRT concept to donors. This next slide might be the most important slide in the deck, especially if you are kind of new to CRTs and you want to figure out, how do I introduce this concept to donors? My very first training class with Crescendo goes back to 2007. And Charles Schultz, the founder of Crescendo, got a big pen out of his pocket and he pulled it out and he said, I want you to always remember BIC, B-I-C, because these are the most important 3 features, and these features are benefits of a charitable remainder trust, generally speaking. And so, Mrs. Smith, you bought some stock in Apple right when Steve Jobs came back in the late 90s. What an amazing investment. Now you're ready to maybe start divesting of some of those shares of Apple. So one of the tools that we talked about, Mrs. Smith, is if you set up a qualified charitable remainder trust, when you donate the shares of Apple, the first benefit is that you bypass the capital gain that you would otherwise face if you sold the shares yourself. So that's benefit number 1. Benefit number 2 is that you receive income, and we can set that up for you to receive income for the rest of your life, or you could set it up for another loved one as well, to be included as an income beneficiary. So income is the I, and then C is a charitable income tax deduction. Now, Mrs. Smith, if you were giving these shares of Apple directly to us with no restrictions, you would get to deduct the full fair market value of those shares of Apple stock. But in this case, since you're going to be receiving income back, or another loved one's going to be receiving income back, the IRS limits your deduction. And they give us some tools to calculate that for you, but it's going to be what we call the actuarial present value of the remainder interest, because this is a charitable remainder trust. And so those are the 3 general most important features of a charitable remainder trust. And you'd be surprised, it may come off hokey. I'm originally from the Midwest, so I'm always going to be a little hokey, but I don't care if you're in California, New York, or Florida, it works. And it gets their mind, you can see the gears working, and they're thinking about assets that are going to be in play either very shortly, like by the end of this calendar year, or maybe in the years to come. and they start thinking that, hey, this could be a very valuable tool for me to solve a lot of problems. And speaking of that, let's talk about uh, the 10 axioms that every gift planner or advisor needs to know about charitable remainder trust. I just kind of started writing these. I'll give you a bonus one right out of the gate, and that is that if you've seen one CRT, you've seen one CRT. Now, that may seem a little dramatic, but it is, if you've done a number of CRTs, you will know that to be true. Even in Mrs. Smith's example, what if Mrs. Smith was married, or maybe Mrs. Smith said, I want to set up this and pay income to me first, but then income to my daughter at my passing, maybe for a term of 20 years. Now you're going from one revenue procedure that's issued by the IRS to a different revenue procedure that's issued by the IRS, and you have different language that is, kind of your safe harbor language that you want to have in the trust. So I truly mean it when I say, each one of them are like snowflakes. They're all different. One of the most important things, especially when you're funding real estate with non-cash assets, especially real estate, but even like an art collection, is understanding who pays for what. When a donor makes a transfer to a charitable remainder trust, they think they've just made a transfer to charity. They have made a transfer to a tax-exempt trust. Charities are the remainder. And so that's a big difference than making a direct gift to charity. And so, for example, when you donate in our previous example with our gentleman who donated the vacant land, the trust cannot pay the carrying costs for the real estate during the holding period. So there's got to be some cash in the trust for the trustee to pay the bills. Now, for a vacant lot, like in our previous example, the only thing that hopefully you would have is property taxes. But nonetheless, you need to have a conversation with your donor immediately, right out of the gate, for them to know that, as while the trustee is holding that real estate, the donor may need to make a gift of cash, or they can donate some stock to the trust, and that money be used then to pay the carrying costs. Very important, because the donor, in their mind, they've given away this property, and that's not how charitable remainder trusts work. Have a game plan that ensures success. What does that mean? It means having an exhaustive checklist of, hopefully sequentially, of every step that you walk through. Not only will that boost your confidence when you're talking to your donor, and they will see that, but it truly is a way for you to communicate with the donor kind of along the way. And they have no doubts that everything is in good order. In the Gift Planners Workstation, which is our software program, you'll see we have countless checklists, but you'll see what I believe to be one of the most exhaustive checklists, hopefully ever to be created, that you can use to kind of walk through setting up CRTs. As I previously just mentioned, communicate with the donor that this is a transfer to trust, not a direct transfer to charity. Sometimes a charitable gift annuity works better. If you have a donor who says, I want to donate real estate, but I just want to be done donating real estate, then in that case, because it's a direct gift to the charity, as long as the charity agrees to it, they can cover the carrying costs during that holding period. But if you're the trustee of a CRT, you can't do that under any circumstances. A CRT should solve a financial problem for the donor. If you can't see where the problem is being solved, then maybe the CRT is not the right solution. What are some problems? One problem could be that you have a donor who has an overconcentration of Apple stock, like Mrs. Smith, and it's now 50% of her net worth. And she wants to divest, but she doesn't want to pay taxes. That's solving a problem. What if you have a son who's not very good with money, and instead of leaving him a $5 million IRA outright, you would rather set up a reliable stream of income for your son for the rest of his life, so that you can manage the spendthrift kind of issues that your son has, so yet solving another problem. You want to cross-reference the private foundation rules under Chapter 42 of the Internal Revenue Code to make sure that there isn't a risk of non-compliance. Excess business holdings. It could be possible that somebody before the sale of their company donates a significant amount of that company, and I believe the private foundation rules kind of cap around 35% of the voting interest in a closely held business. So you could butt up on that, but probably the biggest one that you might have issues with is self-dealing. That's probably the most important private foundation rule that CRTs are subject to that you have to be careful for. Another oversimplified example. So mom and dad donate real estate to a charitable remainder trust. Son wants to buy that property. Son's even willing to offer fair market value for the property. The son is a disqualified person. So that would be self-dealing for them to transact with the trust, just like with a private foundation. However, let's say mom and dad sets up a charitable gift annuity with that same real estate. Son wants to purchase the land. If everything is above board, they can absolutely do that. So that's one of the kind of the differences between another difference you might say between CRTs and CGAs. Higher payout rates can lead to lower income. Very important to communicate to your donor, particularly for CRATs. Again, we don't see CRATs as much anymore, but I have been in very challenging situations in the past where before my time, I saw 9% CRATs established, and you get one downturn, a 20 or 30% downturn in the stock market. That CRAT's never coming back, and there's a big chance that CRAT will run out of money and exhaust before the income beneficiaries do. That typically can't happen with a CRUT, but you can lose same thing. You can lose a serious amount of principal in a CRUT, going through an economic downturn. And so if a donor says, well, why can't I just get the highest payout for a CRUT? Give me 8%. It passes the IRS's 10% requirement. The actuarial present value of the remainder interest has to be 10% to go to charity. Just pay me 8%. Okay, but there are times where an 8% CRUT could actually pay less income over the long term than a 5% CRUT, 5 or 6% CRUT. And that's just because of the vicissitudes of the market. So it's important to educate donors about that. One thing about the two software providers that we use in our industry is that they in their forecast, they show a linear growth rate during the term of the trust. And you can, assume an 8% growth rate, and you might average 8% with your investments. But that's a big difference. Average is a big difference than just linear growth. And so that's not how the experience works with a charitable remainder trust. And it's just important to explain that to your donors. Don't forget the IRS forms. As a trustee, you have to produce the K-1. That goes to the donor. That's their way of reporting their income for the year. And then the 5227 is what you would report to the IRS. Also, if the donor is setting up a CRT and one of the income beneficiaries is not a spouse, especially they want to complete the IRS Form 709 gift tax return because they've made a gift. And then finally, I would suggest having an investment policy statement in place. When there are turbulent times in the market and these income beneficiaries are calling you and they're concerned about, what the future is going to be for their income, it's always good to have, a true north, an investment policy statement that you can go back and review and remind them this is the target portfolio that we chose. Okay. Now, even the best top RIAs in the country who work with the nation's elite plan giving programs do not recommend investment policy statements. So this is something that you'll have to decide on your own, but I recommend them. All right, let's go through these case studies and then we'll kind of bring this in. We'll talk about a couple of our services and we'll bring this in for a landing. So these case studies, I don't go too deep into these, but only to just give you an idea of what might be possible with some of your donors. So Larry and Bonnie, when I first, met them a couple years ago, they're in their 60s, and they both graduated from the same medical school, and they had done well in their career. They were one of them was a board member of a local bank that eventually got bought by one of the big banks, and so they had a pretty significant amount of those shares, and they were ready to donate those, and they had been reading about charitable remainder trusts. So, Larry came to me already knowing a little bit about CRTs. So that was good. But one of the things, the ideas that I introduced to Larry is I said, well, we could set this up at 5%, but would you be willing to consider, you and Bonnie, setting this up as a 6% CRUT, and then having 1%, instead of having that go directly to you, we could just have that go directly to the College of Medicine, and that's $10,000, and you could start seeing your scholarship in action today. And Larry and Bonnie really liked that, and the College of Medicine did an amazing job stewarding them. This is a scholarship for medical students from disadvantaged backgrounds. They felt really good about this, and now just in the last year or two, they've made more outright gifts to see more of those awards happen now. But an example here of a blended gift strategy. Um, Recent one that we just worked on, Ryan was a little bit a part of this too, because the real estate was in Colorado where Ryan lives. But this is a one of the top private universities in the world, certainly one of the top private universities in the United States, brought this one to us. And their donors, Jan and Gary. Um, Gary has a sister, Nancy, who had been living in a property in Colorado that Gary purchased many years ago for Nancy. Nancy's had some difficulties in her adult life from health issues, and so they bought that for her to live in. But Nancy's getting older now and really needs to move into assisted living. So the idea is let's donate this real estate to a flip net income charitable remainder unit trust, like what we talked about at the beginning, and set this up for Nancy. Jan and Gary don't need the income, and so the property appraised for around 600,000. And this happened over the summer. Property's already sold, and it's going to flip on January 1 of this year, 5% to Nancy for the rest of her life. The reason that I pointed out that this was one of the largest private universities in the world, and certainly in the United States, is they have an elite plan giving program. Why would they need us? Sometimes it's really important to have a buffer between you and these types of transactions. The largest charities in the United States, the reason that many of them are our clients is that they're trying to protect their brand. They're also they're also smart enough to know what their talents are, and they're willing to bring in external partners if it helps their bottom line. And that's really what it comes down to. And this was a service that we call a pre-flip. So when we resign as soon as the property is sold and it's converted to a standard CRUT, then we appoint the charity then at that time as the trustee. So they were able to stay out of the title chain. They were able to kind of keep worry about the relationship with Jan and Gary, because things can go wrong, in CRTs. And so, and then we wired the money to their financial services institution so they could take it from here. And we call that the pre-flip model. I'll talk about that as we wind down for today. Ray and Tina. Okay, remember we talked about that a CRT cannot be a shareholder of a sub S corporation. So I met Ray and Tina, and they owned a very valuable vacant lot. It actually tore down a building there in a city, and it's appraised at $5 million. And when they said that, that this was a sub S, I kind of, I kind of got discouraged a little bit, wondering if this was going to happen, knowing what I know about sub S. And so, but I found out that Ray and Tina were the only shareholders of this sub S, husband and wife, and that the only asset in the sub S was this property. So I thought, okay, so I had read about the fact that a sub S could actually be the donor um, and it could donate underlying assets from the sub S to a CRT. And then of course, a sub S is not a living person. So the longest you can set that up for is for a term of 20 years, not to exceed 20 years. And so Ray and Tina, that was good for them. And so the income after the property is sold, the income then will be paid to the sub S, but Ray and Tina are the only shareholders, so dividends flow through to them. So that's how you can work with a sub S corporation at times with and kind of use that with a charitable remainder trust. Howard, a recent gift that we're working on. Howard owns a significant amount of real estate out in the Seattle area. He owns a strip mall, and this is the first real estate gift that he's making. And we went right to the top in terms of complexity with this. Howard was intrigued with charitable remainder trusts, but he also wants to make a charitable impact during his lifetime. And so the property appraised for just around $2 million. So I presented Howard with the idea of what if you donate an undivided interest in this real estate, 50% to a donor advised fund. I mean, Howard told me what he wanted. I didn't tell him what he wanted, but 50% to outright to a donor advised fund, and then 50% to a charitable remainder trust. And so he was intrigued with that idea. Howard owned all of his properties in different LLCs, but it's a disregarded entity because he's the only member. So he just had that obviously for asset protection purposes. So he could, he still controls everything here. So he could donate the real estate and set up a CRT in his name as a lifetime income beneficiary, unlike my previous example with the sub S. So anyway, it's working out great. Once we get that property sold, he'll have 50% of it that we will send to his Schwab donor advised fund. The other 50% will remain in this CRUT. Another example of our pre-flip service model. So when we resign, then we will wire that money after the sale, of course, to the university that is his alma mater that is going to take over as trustee at that time. So another recent example. And then finally, I'm going to save this a little bit because we're going to go deep into this at the NCGP conference next week. So if you're going, that means you have to come to our session. Brian Klontz, myself, and up-and-coming attorney Caleb Nepper are going to be talking about recent cases of complex donations of complex assets. And we're going to go deep on this whole idea of talking to your donors about testamentary charitable remainder trusts on the heels of the Secure Act, okay, and how that can be beneficial. Now, Ron here, it happens to be a friend of mine, and I still do some work for the University of Florida. He's a supporter there. He's about 82, 83 years old. He's got two sons, adult sons, and he's very philanthropic. He's a retired attorney, and he's very smart. So he kind of understands what the limitations are of leaving now his retirement plan assets to his adult children with the Secure Act, which we don't have time to go into today. But he has about 1.8 million in those types of assets. And so what Ron, and here's my paper. And again, you'll have a copy of that paper guaranteed to cure insomnia. But seriously, if you do really have an interest in starting to develop more testamentary CRTs funded with retirement plan assets, we've written a pretty comprehensive paper on this, Caleb and myself. And so in any case, the idea here is at the very high level is that the donor, or if it's a married couple, let's say they both have IRAs, maybe husband and wife can leave each other as the primary beneficiary of the IRA. And then at the passing of the surviving spouse, the testamentary charitable remainder trust, the Smith family charitable remainder trust, would then finally be funded with retirement plan assets to benefit their adult daughter. The adult daughter doesn't have to worry about the limitations of the Secure Act, that she has to cash everything in 10 years. She doesn't have to worry about the confusing required minimum distribution rules. imposed by the Secure Act. She just gets her quarterly income or monthly income now for the rest of her life. Remainder goes to charity. As my friend and attorney Bruce Steiner says, the benefit of the stretch, remember we used to call it the stretch, right? But for most adult children now, they no longer are able to stretch inherited IRAs. But the benefit of the stretch through the CRT may offset or outweigh the loss of the remainder interest. So the only part of that that I disagree with Bruce about is that mom and dad got to decide in number 4 there who those charitable beneficiaries were. It could be their church, it could be their alma mater, it could be whomever. So I argue that is not a loss. And we don't have time for it, but if we have calculators in the gift planners workstation dedicated to this specific topic. So you can, show your donors if your adult child inherits an IRA in scenario 1 and just cashes it in, what's going to be their, the long-term outcome of that decision. If your child waits until the 10th year to cash in the IRA, which they're going to have to do, that's your outcome. But then here's your third outcome. If you left the IRA or 401k or 403b to a charitable remainder trust for your daughter. Okay, let's talk quickly about drafting. I'm just going to say here that whether you're a practicing attorney or not, but if you work for the charity, you have to really be careful if you're serving as trustee, drafting the initial trust instrument. I'm not saying that you shouldn't do it because I think it's an important part of the process. It keeps the momentum going. The drafting of the trust is the number one issue that kills CRTs from ever seeing the light of day. So there's nothing wrong with creating that initial trust instrument. But you want to have also a suite of other documents that go with it to protect you. Like, for instance, a letter of understanding. A letter of understanding could simply be as simple as, remember, Mr. Donor, you're going to have to pay for some expenses while we hold this real estate in the trust, or art collection, or what have you. But the letter of understanding also can have a provision that says that we will draft the initial trust instrument for you, but we are not representing you from a legal capacity. And the donor agrees that they will have their own attorney review that document, and they sign that in the letter of understanding. So protecting yourself is critical. I mentioned the investment policy statement already, and also the exhaustive checklist that you want to have, that you just go through so that you don't forget anything. Drafting the CRT, as I said, is one of the most important parts of the process. This was a study done by Caspic. Of course, many of their clients are some of the top plan giving programs in the US. And they asked them 3 questions. Do you provide, just basically the IRS template to your donor? So then they can take that to their attorney to draft it. Or do you provide, some templates, or do you provide customized templates? And it's not by accident that those charitable organizations that provide customized templates that serve as trustee receive the majority of the new inflows of charitable remainder trusts. So for whatever that's worth, I hope that's food for thought. Now, I will conclude with our 3 CRT service models, and I would point you to the Charitable Solutions website to give you a more in-depth explanation of all 3 of them. There's 3 fact sheets there that you can download and review. But just at a very high level, I've already mentioned that pre-flip model, which is great if you're a robust plan giving program and you're comfortable serving as trustee, but you don't want to serve as trustee of real estate, pre-flip, or some other, maybe closely held business asset, something that's going to take a lot of work by your team and something that can create risk. And maybe even be an issue with the relationship that you have with your donor. So the pre-flip is a good solution there. The trust-only model is good if the donor wants their financial advisor to manage the underlying assets in the trust. So we do the administration, the K1 5227. We will monitor the investments as the trustee for sure, but that's an option where the donor can bring in their own investment advisor. And then finally, we have the turnkey solution where we do have model portfolios that we use. So we do the investment management on top of everything else that I've already mentioned. So with our time today, we went over a brief primer on CRTs. We spend a good bit of time on how to introduce the CRT concept to donors and those 10 axioms to keep in mind. There are probably many more axioms as the more I think about it, but those were the main ones that I can think of that come up often with CRTs. I hope those case studies, even though we went through them quickly, captured your imagination for what's possible with setting up CRTs. If you're interested in testing out our drafting tools in the Gift Planners workstation, I would encourage you to go to estategiftplanning.com. You can get a free 7-day membership, see all of the different features of the workstation, but one of them is the ability to draft charitable remainder trusts in different varieties. And then we went over our 3 CRT service models. So Ryan, with that, if you have any final words or final thoughts.
I wanted to thank you for an excellent presentation. I thought it was going to be challenging to improve on Tuesday's session, but I think you've done it. I thought that this will be the one that we'll use for the recording. I wanted to thank everyone for tuning in, and here's a list of prior free webinars, all available, hosted on, I think, YouTube now. And we'll send out the recording for this webinar along with the Q&As and Paul's paper next week. So thank you all for tuning in. Thank you, Paul, for another great session.
Thanks, Ryan. Thanks, everyone, for being here.